Welcome to INN's coverage of PDAC, which runs online this year from March 8th to 11th. You're about to watch my interview with Jeffrey Christian of CPM Group. It was filmed on February 19th, and the topics covered include the outlook for gold and silver this year. You'll be able to find all the rest of our PDAC coverage right here on our YouTube channel, and we hope you follow along and enjoy. I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for being here online with me today.
It's my pleasure, as always.
Of course, and we are here to talk about precious metals, and I think the place to start off right now is with silver, partially because it's been getting a lot of attention right now, and partially because I know by the time we publish this interview, CPM Group will probably have held its PDAC silver webinar. So just to begin, I want to start by asking why CPM Group is bullish on silver right now.
Well, we have been bullish on silver on a long-term basis for several years. But we've been saying that, at some point, like maybe 2023, 2025, silver prices can go sharply higher. And we've been saying that because, supply is relatively flat. A lot of it comes as byproduct of copper, lead, zinc, and gold. We have some expectations that production of gold is going to decline, and that would reduce byproduct silver production. But we're also looking at solar panels, increased use of silver in electronics, increased use of electronics and electrical systems everywhere. And we're saying that, we expect relatively tight fabrication balance between fabrication demand and supply. But the real kicker is always investment demand. And investment demand has been very low for the last 4 years. I mean, it was declining from 2014 to 2017. And then in 2018 and 2019, it was very low, like 27 and 35 million ounces. And that's just at that price, at that level of investment demand, you're not pushing the price up, the price is falling. And the price was moving sideways. And so last year we started saying, look, the price is too low. If investment demand comes back, then the price will rise and rise sharply initially. We thought maybe $24, $25. And, we kept advising the mining industry to do something to stimulate investment demand. They didn't do anything. The politicians in the United States and in the UK and to some extent in Russia and Canada came to the aid. And they gave investors a whole bunch of reasons to invest in silver. And silver investment demand went from 35 million ounces in 2019 to more than 100 million ounces last year. So that pushed the price up. And going forward, we think that those economic and political problems that have caused investors to say, I want more gold and silver, are going to continue. And that's going to put pressure on silver prices in the long run. In the short run, you've got a technical chart pattern. You've got an ascending triangle with a ceiling around 28. We've broken above the $28 twice. Once last August when the price got very bullish and into July into early August, and the price got up to about $29.50 or so, and then came down very quickly. But it didn't come down as far as it had been. And then on February 1st, it shot up to $30.50 or whatever. And then it came down, the next day it was below $29, and it's been below $28 since then. We think that $28 level is going to be pierced, and we could see another spike up. Everything's there, and you've got a lot of people who have poured into silver since February 1st, since the WallStreetBets people came in and publicized silver. We think that you've got a lot of new entrants into the silver investment demand sector. It's going to keep investment demand high, and it's going to cause prices to be strong over the next month or so.
Okay, I think that gives us a good picture of what you're looking at CPM Group for silver. I want to take a brief foray into a little bit of what's going on with the recent interest in silver that we've seen. So just a brief recap, I know you've talked about it a little bit. There is a wave of attention for silver toward the end of January, early February, arguably continuing a little bit right now, all connected to what was going on with WallStreetBets and GameStop. What do you make of that activity in the market?
Well, first off, again, the investment demand and interest in silver had preceded that. We saw investors buy 3 times as much silver last year. Before that, the Wall Street bets people didn't understand the silver market. They didn't understand the difference between commodity markets and equity markets. They had a fun run with GameStop and AMC, and they listened to all of the nonsense on the internet about how there are these massive short positions in silver. And those there are large short positions in the silver futures markets, but those are hedges of long positions in the OTC physical market. So they're not naked shorts. And a short position in a commodity futures is radically different from a short position in an equity, where an investor or a speculator has actually borrowed stocks that he's going to have to buy back in the market and repay that stock loan. So they didn't understand the silver market. They bought the Kool-Aid of this nonsense, which has been going on since the 1980s. Oh, we're going to run out of silver. No, and there are these massive short positions. In the 80s, the guys who promote this said it was Drexel because they had worked at Drexel. Drexel went bust, so it was Merrill Lynch. Merrill got out of precious metals, so it was JP Morgan. It's the same story 40 years later, and it hasn't happened yet because there isn't this massive naked short in the silver market. It's that simple. So the Wall Street Bets guys came in, they made a big stink. They brought a lot of investor attention to silver. It may have been misguided attention, but it was attention. In addition to that, you have a lot of people who did very well in silver and in gold last year. And in the early part of this year, they were repositioning their portfolio. So they're saying, okay, gold, as you said, rose sharply into early August last year. And it hasn't really fallen sharply, but it has fallen, and it hasn't, made new highs the way some people may have thought or expected or believed. It's believed. They don't think, they believe. Believed that it would. And so they've been cycling out of gold into silver. So you have an environment that's conducive for investors to pour into silver. And the Wall Street's bet boys just sort of like brought it to the fore.
Right. So, and regardless of all of that, you are positive on silver. I wanted to ask for your price prediction for silver as we get toward the end of 2021. And for investors, at what level is it still a buy, and at what point does it become not a buy, perhaps?
Well, in terms of investor buying levels, it depends on who you are. If I were a short-term investor, I would be buying today with the expectation that that $28 ceiling resistance level is going to be taken out, and I could probably sell it back within a week or a month or 2 months or 3 months at something higher. I wouldn't necessarily be a buyer as a long-term investor because I think that that's a very short-term type of thing, and you sort of have to be sitting there watching the market to make money on those kinds of short-term trades. From a long-term investment perspective, I think that this is probably a good level to buy. But again, I think that you're going to you should go into that with your eyes wide open and say, I may be holding this silver for 3 years, 5 years, 7 years before I see the kind of significant return that I'm expecting. There are all these people talking about $100 silver and $300 silver. That's all nonsense. If you know anything about the supply and demand, the physical supply, what it costs to produce silver. The supply of silver that's in old jewelry and decorative items that can be melted down and refined into bullion on short notice, and the demand elasticity among fabricators, including electronics companies and others. You know that the price can't spike up there and stay.
All right. So moving over to gold, I think that the last time we spoke was back in August when gold was having a lot of price momentum. It passed 2000, reached an all-time high. So for gold, my question is, how did we go from those very high levels to where we are right now, which is still high historically, but lower than we were last year? So what was the journey for gold?
Yeah, I mean, you've got to put the low gold prices into perspective. Gold prices today are higher than they've ever been prior to June of last year. So yeah, we're off from the high, but we're very strong. And there is a tremendous amount of gold interest that's still there. But like, what we've told our clients, like, for example, in August, we were saying, don't buy into this market. Wait, we expect the price to fall in October, and then wait, because we thought the election and the aftermath of the election would drive prices higher, which it did. And then we saw seasonality, which is typically strong in January and February. So we were telling our clients, if you're not going to buy in September and October, wait until the second and third quarters of 2021. There's seasonal weakness. Fabricators, jewelers, and electronics companies often shut down and do inventory and take vacations at that time. There are a number of reasons to expect prices to be lower. In addition to that, a lot of the investment demand in gold last year that pushed the price to record levels was based on economic and financial and political issues, which we thought would be getting better by the middle of this year. And we still think that. So our view has been for some time, we thought we'd see strong prices in 2020, which we did. We saw a tripling of investment demand in gold too, as with silver. We saw a very sharp increase in the gold price. And then we've been telling people we thought that 2021, 2022, which would be characterized by getting the pandemic under control, rebuilding the economy after the recession, and maybe, just maybe, a somewhat less dysfunctional political environment in the United States and on a global basis, that those three factors could lead to not necessarily a decline in gold prices, but a slowdown, a plateauing. We thought that the increase in gold prices 2021, 2022 would plateau, that we'd still see increases, maybe 6% this year on an annual average basis, maybe, 5% next year, but that all of those political and economic problems are still there. They haven't been resolved. Some of them have gotten worse, and the political dysfunctionality will be back. I mean, it's not going away. So we think that at some point we have another crisis similar to what we saw in 2020 or 2008, and that drives gold prices to record levels. So we're still bullish on gold. We're not surprised that the prices calmed down after spiking higher. Part of that spike had to do with congestion in the August COMEX contract, which is why we were telling people, look for the gold price to peak in early August, because the roll out of the August contract into December would occur by the beginning of August. And it's sort of run like clockwork.
All right, so just so we understand, we have some factors, underlying factors that drive gold. They've gone dormant at the moment and probably will for the next year or two until something else comes out like we saw last year to drive higher?
Exactly.
All right, now I want to ask the same question for gold that I asked about silver, which is where CPM Group sees the price by the end of 2021, and at what level would you consider it a buy or not a buy?
Yeah, well, I definitely think it's a buy from a long-term perspective below 1800, which is where we are as we're filming this. From a long-term investment, our expectation, as I said, is we think that the annual average price this year will be about 6% higher than last year's annual average price. And last year's annual average price was up like 37 to 43%, depending on which price metric you use. So we had a very sharp increase last year. Looking for about a 6% increase in prices this year. That would put prices like 18 to 1880 by the end of the year, possibly a little bit higher. So we see incremental increases, mostly in the fourth quarter of this year. Like I said, we're expecting some weakness, or not weakness, but softness in the second and third quarters. Fourth quarter, you tend to see seasonality. And by the fourth quarter, we think that people will be looking at the 2022 by-elections in the United States, and there'll be some other economic issues that we think will be more problematic. So you'll start seeing investment demand come back into the market. So that's what we're sort of looking at on a short term. A long term, we're looking for record prices within the next 3 to 5 years.
Looking at gold and also back at the silver market, are there any aspects of things that are going on right now that you think investors in general are missing? I think you've talked about some factors, but just want to directly ask that question.
That's a loaded question. I don't know where you got the question, but yes, I mean, we've been looking at gold and silver. One of the things that you've seen is a number of bullion banks either getting out of bullion, precious metals trading, or severely reducing their positions. And what that has led to is a reduction in the liquidity in the wholesale gold market and silver markets. And that has caused friction, and it causes increased volatility because it's harder to find counterparts in the financial intermediaries to trade with. So that's a big factor there that I think has largely gone unnoticed. Another factor is in gold. You saw central banks pull back sharply from gold purchases last year. The Bank of Turkey bought gold, but they created a bond, a gold-backed bond, in order to supply cash into the Turkish economy at the time of the pandemic, the economic lockdown, and sanctions against Turkey. And Turkey has a lot of animosity toward it on the part of Russia, less so on the part of the EU, which is its major trading counterpart, and somewhere in the middle with the United States. So Turkey's got a lot of bad things going for it. And the Turkish central bank did this incredibly astute thing. They said, look, you need cash to live. You can turn in gold, and we'll give you a gold-backed bond to allow you to have cash, which you can ultimately repay, sell the bond back, and get your gold back, or get gold back, not necessarily your gold, but get gold back. So they're utilizing gold as a quasi money, which is, it's the kind of genius thing that other central banks ought to do, but with the exception of the Reserve Bank of India, no one else is doing that. And that's another thing. And then the third thing is, it actually relates to the liquidity issue. We've seen a lot of gold and silver back up in the physical market. As I said, investment demand was very low 2018, 2019, and it was actually pretty weak for 3 years before that. And a lot of investors were selling gold and silver back to market makers, and it was building up. So you have record inventories in gold, silver, in London, in New York, in Zurich, in China. And the guys with the WallStreetBets who keep saying there's no silver, they don't understand. There is plenty of silver. There's like 450 million ounces of unallocated silver in London alone. So there's plenty of silver and gold available in the markets. And as I said, senior management of these banks are saying, hey, we want to reduce or get rid of our bullion exposure. And then they say, wait a second, you have more bullion on your books than ever before. So not only have we not reduced our exposure to precious metals, it's at a record high. So one of the things that you saw in 2020 was that some of the banks in London were taking their gold and silver, selling it, buying ETF shares. Now they have equities. Equities aren't held by the bullion trading department. They're transferred to an equity trading department. And some of those shares in the ETFs were sold late last year. That's important because a lot of people use the ETF inventories as a surrogate measure of investment demand. And so you saw like silver go up 330 million ounces in terms of ETF holdings of physical silver last year. People saying, my God, investors have never bought that much silver before. And they were right. And they hadn't that year either. Possibly as much as 200 million ounces of that was these banks using the ETFs to reduce their exposure to physical inventories. And it's distorted a lot of people's attitudes about how strong investment demand was last year for gold and silver. It was strong, but not as strong as the ETF data would suggest.
Okay, brief diversion here to follow up on one thing you said. If we have these inventories of metal sitting there, why do we hear about shortages and things like that? Is it a matter of it being in the wrong place? What's the story there?
I think there are three things. There is a little bit of location dislocation, but that's a minor factor. The big two factors are a lot of people who talk about precious metals don't know what they're talking about. They just get it wrong. And some of the people know what they're talking about, but because they're in the business of marketing precious metals investments, they purposefully acknowledge, they're fully aware that they're misstating what's going on. So you hear all this talk, for example, there's not enough bullion in London to meet the ETF demand in early February. And that wasn't the problem. There's plenty of bullion in London to meet the ETF demand. But what happened was when you're creating new shares, it's a physical process. We're delivering physical gold to you and silver to you. It's not necessarily that we're physically delivering it, but we're delivering you warehouse depository receipts that says, I own silver at the HSB vault in England, and I'm giving it to you. Give me shares of the ETFs. And this is a process that often daily volumes are a couple 100,000 ounces of metal in shares. And in the first 2-3 days of February, it was 95 million ounces. And then in the 4th and 5th days, there were sales of these ETF shares that were about 40 or 50 million ounces. So you had this enormous processing of paperwork, really what it was. And that was the friction in the ETF transfers and creation of the shares and then redemption of the shares. It had nothing to do with, oh my God, there's no physical metal there. It had everything to do with a system that is geared up to handle 200,000-300,000 ounces a day, all of a sudden handling, 95 million a day. Well, okay, 45 million a day.
Okay. Before we let you go, I do want to touch on the other precious metals, platinum and palladium. We all love to talk about gold and silver, but we hear less about platinum and palladium. So maybe just a brief look at those markets right now. What should investors be paying attention to there?
It's very interesting because a lot of people have come to us and said, can we do a platinum palladium ratio trade? And we keep saying no. I mean, you can, but don't. What we keep saying is buy platinum. And the platinum price has gone from like $800, $900 an ounce to $1,260 an ounce. And it probably will go further over the next several years. It's gone a little bit faster than we thought because people are pouring into platinum. But we've been saying don't sell palladium short to offset your long platinum. Buy the platinum, but hold on to your palladium. And what we've seen, it's interesting, is what we've seen is a lot of institutional investors and individual investors have looked at the platinum palladium ratio and they don't do it. They buy the platinum, they may liquidate their palladium, but they're not going short palladium. So if you look at the short and long open interest on the palladium futures contract, they're both very low. People have liquidated their long positions, but they haven't replaced them with short positions. They're saying, okay, palladium's at record levels, but I'm not going to bet that it's going to fall. I'm going to take my profits and I'm going to take those profits and I'm going to put them in platinum. And that's really the gist of what's going on in platinum and palladium.
Okay. Last question. Any other advice or things that you would want investors to take forward with them into the new year?
Well, I think that investors ought to rely on CPM Group for quality information. I mean, with the increased interest in precious metals, and with the fact that you have this non-curated, it used to be that when you wrote something like, in the precious metals markets or in the equity markets or in the financial markets, there was always somebody who had qualifications to review it and say, oh, this is garbage, we can't publish this, or this is good, but it needs these changes, or this is good, let's run with it. And that doesn't exist anymore. Anybody can throw anything on the internet. And they do. And you have to be very discriminatory about where you're getting your information. And years ago, I said something about the poor quality of information in the precious metals markets, and someone was interviewing me and they said, oh, you're talking about the conspiracy theorists. I said, no, I'm talking about the major participants in the precious metals market, marketing groups, industry associations that promote investment demand, and the companies that they hire to support those theses. These guys, in many cases, just don't know what they're talking about, and they get it wrong. And the information is bad. So, I was saying, okay, you have the Turkish central bank business, you have the decline in liquidity in the core market, you have the increased use of ETFs by bullion banks to reduce their exposure to physical metal. Those things are just not being reported and discussed and analyzed in the core market. That's how poorly analyzed and understood precious metals are.
Okay, well, I think that's a good note to leave it on. Definitely, that's some great advice for the age of the internet that we're in today. Thank you so much for being here to talk with me about precious metals.
Well, thank you for having me and inviting me.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.